Uday, firstly, thanks very much for taking time out to speak to us. Now, as we sit here today, we've seen some big global macro events take place over the last few days. There was a view that Greece would leave the euro. That hasn't happened. The Grexit that everyone spoke of hasn't happened. And then we've had the Fed decision that came a couple of days back, where much to the disappointment of the markets, the QE that it was expecting hasn't happened. Would you say things are not as bad as they're being made out to be?
George, first of all, on the macro event side, I remember the principles of economics. Marginal utility of every macro decision diminishes as you have more and more of it. So QE1 had a bigger impact, QE2 had a lesser impact than QE1, and I feel the marginal utility of each of these decisions is dropping. And therefore, when you saw the news on Spain bailout, it lasted 24 hours before the market started questioning it. You saw the results of the Greek election, it lasted less than 24 hours before the market started questioning it. Therefore, I am actually getting concerned about too much attempt to keep things okay by disproportionate expectation of drugging.
Right, but the market, while it does seem disappointed that the Fed didn't do a QE3, somewhere would you say that the expectation is still there to the extent of the Fed's wording of its statement that it says that it is prepared to take further action? Would you say that somewhere the market is still keeping this hope that you will see another round of QE?
I think there is hope, and there is a reason to believe that before a presidential election, something can happen. The issue in my mind is whenever policymakers are taking decisions for intended economic outcomes, what is happening is unintended market outcomes. The last thing the Fed would like to see is post a QE3 a dramatic amount of spike in commodity prices, because that's bad for the real economy, and the US consumer pays a higher price at the gas station. Therefore, how do you balance between a desire to hold the economy versus unintended market outcomes, querying the pitch for intended economic outcomes?
Sure, but still, as someone sitting at a very senior level in an emerging market, what would you have liked to see the Fed do?
I think you've got to keep enough ammunition that the economy holds up, but don't artificially try to pump prime it, because it is leading to unintended consequences. One of the very good news of a more balanced approach is the commodity cycle is correcting. And it's not just oil, it's other commodities as well. And this is a fundamentally better economic outcome because it keeps prices of commodities low at a time when you have low economic growth.
Right, so now, just touching upon the commodities point, QE2, everyone agrees, didn't do most of the global economy a whole lot of good, specifically emerging markets, because of commodity price inflation. Would you say that a QE3 is going to do more harm than good for emerging markets like India?
In my view, if it is excessive, it can. See, finally the issue is India is stuck between need for foreign flows and need for low commodity prices. Unfortunately, the correlation is low commodity prices is low foreign flows, high commodity prices is high foreign flows. From an Indian point of view, I would much rather see a fundamental improvement in India rather than steroid-like capital flows.
Focusing on the energy markets, they seem to be telling us a different story. If you look at Brent crude, it's off something like 30% from its 2012 peak. What would you make of it? Would you say that that is somewhere indicative of global growth in 2012 being much lower than what we initially expected?
I think it's number one on growth. It's number two on the fact that the political situation, particularly around Iran, looks to be better. Therefore, geopolitics at this stage seems to be more stable. And number three, a significant transformation in the global demand-supply equation on energy, especially after shale gas in the US and increased production by countries like Saudi Arabia. Therefore, the demand-supply balance is also getting better. So we are seeing a fundamental change in price of oil and energy.
At the start of 2012, all of us said that 2012 is going to be a breakout year for brick equities. The view was that you'd see inflation beginning to come off. Expectation was that the rate cycle would begin to turn. Today we're sitting in the middle of 2012. We've seen none of that happen. What do you believe the outlook for the remainder of 2012 is?
I think, George, you've got to divide it into two parts. One is economy and then is markets. I think the economy's trajectory down, which has started about 6 to 9 months or a year ago, is still probably not bottomed out. So you got to first see the economy coming close to bottoming out. And then when we are confident that we have bottomed out, we will see the beginning of the economic outlook either remain flat for a while or gradually trend up. Equities will move ahead of the time when economy starts trending up. But the risk is economic outcomes may remain flat for a while rather than trending up in a hurry. The equity market turning around depends on a judgment call whether the economy is still on the downward track, flattens out, and how long it remains flattened out.
Right, now you engage with the global investor community on a regular basis. When you engage with them, what is it that they tell you that they'd really like to see come out of India? Do they say that they'd like to see the government move really fast on the issue of reforms? What are their biggest concerns about India before they say they're going to allocate capital into this market?
See, first, the global long investors, as distinct from hedge funds, are not getting dramatically new pool of money. That's number one. Number two, they have the ability to invest anywhere in terms of opportunity. Number three, at this point of time, the global community also gets influenced by global media. And global media at this point of time is not very kind. And then news about rating agencies. So the global investment community is not at this stage in a tearing hurry to dramatically increase allocations to India. What we need to do is what makes sense for investors, global or local. The problem which I face or I am unable to have clear answers on is if Indian equities have to do well, where are the Indian savers? We are only depending on some foreign saver to come and save us. The Indian saver over the last 4 or 5 years has been extremely smart. He's protected his capital. If you look at the peak of the equity markets, which was January 2008 to now, markets are down 25%, so he would not even have got his principal. So for the Indian saver said, I'm better off putting money in fixed deposits and gold. And so far, he has been smarter than anybody else and any of us on the one hand, and certainly smarter than the global saver. Because the global saver has not only lost in rupees, he's had another 25% loss on the currency. Okay. So I would say if we want a sustainable recovery of the Indian market, we need to be able to justify that investing in Indian equities at these levels makes sense, first and foremost of all, for an Indian saver. If we have that conviction, then it is much easier to expect the global saver to change his view. Why are we depending only on the global saver to bail us out?
So would you be of the view that, today the market is at an attractive level enough for people to start coming back in and, putting their money there?
The saver mentality is something we need to understand. The saver mentality to be positive about equities started 2003 and it peaked all the way up to 2008. So there is a time lag for an Indian saver to start getting comfortable. He didn't come and put money in 2003. He came in 2005, 6, 7, and just as he was getting more and more comfortable with equities, he got a shock. So that is one. Second, I think it is extremely important for Indian intermediaries and Indian corporate sector to protect the trust of the saver.
But somewhere that trust has been lost if you look back to the experience of many savers over the last few years.
Absolutely. And for a variety of reasons, some of them external, some of them internal.